Welcome, everyone, to this inaugural webcast on the future of energy, sponsored by the University of Oklahoma Energy Institute. My name is Bruce Stover. I'm a retired energy executive and member of the board of the Energy Institute at OU. Joining me today are my colleague, Mr. John Westerheid. John is Vice President, Chief Strategy Officer for Ming Energy Partners, and also an alum of the Institute's Energy MBA program, as well as our special guest speaker, Mr. Scott Sheffield. Scott is President and CEO of Pioneer Natural Resources. The title of this first program is An Industry in Crisis, Challenges and Response. Let's get right to it. Scott, you and I go back a long ways to the early 70s in our history. And we, as graybeards, we've kind of been through lots of ups and downs. The one in the early to mid 80s was particularly compelling in my experience, and probably for you too. But this one feels different. How would you describe it?
Thank you, Bruce. It's great to be on to meet John also. And I've been through 6 downturns. I sort of put the 81, 86 as 2 downturns. We sort of had the 81 downturn in 86, and then we had 98. So we had 3 downturns in my first 30 years. And then what's interesting, in my last 11 years in the industry, we've had 3 downturns. So the downturns are happening quicker. This downturn is what I call a double black swan. We had a price war between Saudi and Russia, coupled with COVID-19 pandemic. And this downturn is different. We've never seen a loss of 20 million barrels a day plus in the demand side of the market. So all the previous downturns, we had some loss in demand. Demand eventually came back fairly quickly. But that's the big question in this environment is how fast will demand come back? And then we had the president of the U.S. get involved for the first time. And he called up Mohammed bin Salman, the crown prince in Saudi Arabia, and he called up Putin and got them to strike a deal after their falling out on March 6th in Vienna. And so we've seen oil prices recover quickly, but not to it's what I call it stabilized the market. At least we're not seeing minus $37, which we did the last week of April. We're back up in the $36 to $40 range. It's not going to create a lot of activity, but it definitely has stabilized the market. At least people will survive. I don't think there'll be as many bankruptcies when you see $35 to $40 oil, but we're not going to see a lot of new activity, whether it's drilling. But the big unknown question we can discuss later is demand. How fast will demand come back? Most people have demand back up to about 90 million barrels a day in a market of about 100 million barrels a day. So we're back to 90. The big unknown factor is how are people going to change their lives with COVID-19? Are more companies going to allow their employees to work from home and drive less? Also, what's going to happen to the airline industry? They use 8 million barrels a day, the world's 100 million barrels a day. And how fast are we going to feel safe in flying back as countries open up over time?
Scott, thank you for that. Now, relative to you and Bruce, I have much less experience in the industry and slightly less gray hair. But after the last downturn, what I noticed is that the industry responded with a sharp focus on driving operational productivity and driving out cost. This led to a leaner, meaner, more globally competitive U.S. oil and gas industry. Do you believe that there's further running room with this trend of improving operational productivity? And if so, what do you think needs to continue or change relative to the workforce and the technology that the industry uses to improve this?
Yes, John, that's a great question. As we know, in late 14, Ali Naimi, the Saudi Arabian oil minister in Saudi Arabia, decided to flood the market in late 14. And he wanted to stop shale oil. He wanted to stop exploration around the world. He wanted to stop oil sands in Canada growth. And the thing he did not stop was the oil shale growth. And so the independents, along with a couple majors, began doing things differently. We moved to what we call a slick water design in most of the frac areas, where there's the Bakken or the Permian or the Niobrara play or the Eagle Ford. We also started going out to 10,000 foot laterals, up to 12,000 foot laterals versus 5,000. We started changing to what they call a plug and perf design. And so there's some things that we learned how to adopt to a $60 all price market. So before we were in an $80 to $100 price market. So we learned how to make money in a $60 price. Now we're in a $40 all price market. So the question is what's left? Now it's already understood that the type curves already have peaked out. We are not making better wells in regard to the oil production in all the various shale basins. So I think people are starting to drill closer and closer, too close on their spacing. And so that's one issue. We're not seeing improvement in the type curve, but we are seeing still improvements in drilling and completion technology. For instance, we averaged last year drilling a 20,000 foot, 10,000 feet down, 10,000 foot horizontal in roughly about 20 to 21 days. We're now down to 16 days. We've drilled our last 5 wells in less than 10 days, 20,000 foot. And so we're setting goals. We are putting each of the drilling contractors. We have a competition going. We got better communication. We're using geosteering. We have our geologists working with the drilling engineers. So all that, I still see significant improvement on the drilling and completion technology, which means we're going to spend less capital to get the same amount of production over time. So I'm optimistic there is more. We're in the 6th inning, in my opinion, in regard to those efficiencies.
You mentioned this before, but the industry's gone through painful processes of consolidation, restructuring, renewal after all these downturns. What might the world look like this time? The upstream sector, downstream, midstream, and even the service sector.
In the past down cycles, I think the one where we had the most consolidation was in 98 to about 2001. We had essentially half of the major oil companies disappear. Our company that we both started with, Amoco, disappeared, Arco disappeared, Mobil disappeared, Texaco disappeared. And so we've gone through other downturns. So we got this double black swan. The issue with the consolidation, the biggest issue is the fact that there is too much leverage in the industry. So the industry got blindsided with this double black swan. And so even though oil has come back to $40, but when you look at the ratios, the debt to cash flow ratios of most independents and the majors are the highest they've ever been. And so it's hard to consolidate with a company that has a worse balance sheet. So that's why we haven't seen much. The second issue we've dealt with is from the investor issue. The equity markets were open in 2014, 15, 16, 17. The equity markets for the independents have been closed. 18, 19, they're closed now. And so the investors do not want any oil and gas company to go to the equity markets. They've changed their model. So it's going to take time. And so when oil prices do come back, I think the independents are going to try to reduce leverage. I think most people need to combine themselves. They need to consolidate, because what's really changed is the S&P 500 weighting of energy was 30% in the early 80s. It was 10 years ago, it was 15%. Today, it's down to 3 to 3.5%. In fact, at the bottom of the market just a few weeks ago, it was down to 2.5% of the S&P 500. So Exxon just 10 years ago was the world's largest market cap company. Today, I'm not even sure they're in the top 20. So things have changed, and we got to change our mindset. There will be consolidation in the service sector. That's happening already. I think that will definitely happen. Consolidation needs to happen, but it's going to take time for it to happen, Bruce.
Scott, maybe pulling on that thread a little bit more around the competition for capital. As you mentioned, over the last few years, investors have seemingly lost favor with oil and gas industry. Additionally, we've seen large amounts of capital flowing into funds and companies seen as having an advantage or less risk related to environmental, societal, and governance issues. For you, what do you believe the industry needs to do to regain favor with investors and retain that favor? And then additionally, what does the next generation of competitive, differentiated oil and gas company look like and behave like?
What happened about 18 months ago is that several large investors had meetings with several CEOs in the industry. They wanted to change the model, stop focusing on production growth. We all know we added 8 million barrels a day in the US. It all came from shale. We went from 5 million barrels a day to 13 million barrels a day. We peaked in February of this year. And so we competed with OPEC. We competed with OPEC Plus, including Russia. And that's what's caused some of the downturns in 14 and this year is the growth of US shale. The investors want us to focus on a free cash flow model. They want to have very little growth in companies. In fact, if you look at who owns energy stocks today, there's nobody in the growth sector owns energy stocks anymore. There's nobody in the growth in the growth mutual funds that want to own energy stocks. It's the value, it's the dividend funds that want to buy. They're the current owners of all of our stocks that are public. And so the focus is on free cash flow. So I see the industry resetting growth from the days of 10, 15, 20, 25% per year down to something like about 5% per year. They want a good base dividend around the average of the S&P 500, maybe 2%. And then eventually the big question is, and I've been discussing with investors, whether to create a variable dividend. A variable dividend reason is because our commodity price fluctuates so much. It's hard for us to increase our base. So the majors kept increasing their base over time. And now you got Exxon at a 7% yield now. And so your base gets up too high. The independents can't do that. So we're discussing creating a variable dividend. So when oil gets back to $60 or $70 someday, we'll take that excess cash flow for that given year and take away our base dividend, which we pay out on a quarterly basis. And then we'll pay that excess cash flow as a variable dividend. Now, I think that's going to be the future model. Secondly, we have to clean up and be great stewards of the environment. So ESG, there's been a big movement on ESG around the world and looking at fossil fuels. We know what's happened to the coal industry. So I've been a big advocate in regard to reducing flaring in the Permian Basin. As we all know, the Bakken and the Permian Basin are two of the biggest flares in U.S. shale activity primarily due to lack of gas pipelines. We have to do a better job of planning, getting gas pipelines connected, getting processing plants built, but we can't sit there and have a big black eye in regard to flaring intensity. So I've been an advocate to reduce flaring significantly in all of our shale plays because that's going to affect whether or not investors will come back into buying these stocks at some point in time.
We've talked a lot about oil. Let's talk about natural gas for a minute. Is there a different outlook for natural gas in your opinion?
Yes, I still think natural gas is going to be it has a better growth story long term in the world and probably still a little bit in the US. We still use about 20% of our electricity from coal. I predict that number will continue to go down substantially. Natural gas should capture half of that. Alternative energy will capture the other half. And so we still have that potential in this country. It is a cleaner fuel in the US. It's a cleaner fuel worldwide. And so the adoption of natural gas worldwide still has a bright future. That leads to LNG demand. We're going to have to continue to export LNG. We have the ability today to export up to 9 to 10 BCF a day. We're only exporting about 5 to 6 today because there is a loss of demand due to the pandemic around the world of gas, just like oil. But it's got a bright future. I think it will continue to have a bright future in this country. Already the gas strip next year is about 260. And so what's interesting, the best performing stocks in the S&P 500 in the energy sector are the gas stocks in the Marcellus. So,
turning our attention to the continuously dynamic global energy policy space, we see potential for continued change and maybe disruptive change on the policy front. What policies are you advocating for, and what ones have most of your attention? And which policies do you believe will allow the U.S. to remain a global energy leader?
The big debate that's coming out is who's going to be elected president of the United States in November. We could see some dramatic shift. As we know, the Democratic Party is moving further and further left, more toward Elizabeth Warren and Bernie Sanders. They essentially want to get to a point where they want to ban fossil fuels. The moderate Democrats, we hope, are the ones that will be in office, and they'll adopt the same policies that we've seen over the last several years. The big policy that was a big change for this industry was lifting the crude oil export ban in 2016. That was under President Obama. Other policies we continue to need to be able the ability to improve infrastructure and to expedite gas pipelines across states. That's a big question mark under a Democratic change in the administration of how fast will FERC move to allow new gas pipelines to move gas from the Northeast down to the Gulf Coast. The big question also, will new LNG, there's about 5 BCF to 7 BCF a day, over and above the 10 in projects that are in the works. Some are in question right now in regard to the economics long term, but we need to continue to expedite the building of more LNG projects, because we know we do have lots of gas. There's lots of gas in the shale plays. We call it associated gas, and there's still a lot of gas in the Marcellus and Utica. So we need to continue to have policies to expedite the building of plants and also the building of processing plants, also the building of new gas pipelines going forward.
Scott, let's look at the energy macro going out a number of years. You mentioned in your opening comments that this demand destruction was because people quit driving, people quit flying. And it's been radical and significant. I don't think anybody could have, it's certainly unprecedented in our lifetime. But it does indicate that people are making different choices. Even as we come out of this COVID crisis, this health crisis, people are going to be making different choices. Do you see for example, do you see peak oil demand, particularly in the oil sector, the transportation sector, peaking sooner rather than later? And if so, does that leave space for electrification, which is going to be, natural gas has a big role in that?
Yeah, thank you, Bruce. That's a good question. You see positives and negatives coming out of COVID-19 environment. You're seeing a potential movement of people out of the cities and people buying cars again, especially in China. So people are questioning, do I want to live in New York City or do I want to live in Beijing for my next 20, 30, 40 years? Is it better to live in a smaller town? So I think you could see movements of population around the world to where they will actually increase gasoline demand. They'll buy more automobiles. People don't want to be on a subway or public transportation. That could be a change. On the negative side, for instance, we have 10 to 15% of our employees. We have about 1,000 employees in our office in Dallas here. And we've polled them already, and about 10 to 15% want to continue to work from home. And so if we do that throughout the U.S. and more people work from home, there'll be less driving to the office. They'll be at home all day long. And so there's some pluses and minuses that will come out of that. And so we've seen a couple of the majors in Europe already made comments that we may have peaked oil demand already. First quarter of 2020 at a little over 100 million barrels a day. And so we're back to 90. And so the question is, most people are predicting that we're going to get back in 2022. So I think if we get to 100 million barrels a day, and so if we get a vaccine or vaccines in the next 12 months, and people are not afraid of flying, at least we'll get that 8 million barrels a day again for jet fuel going again. And with fuel costs low like it is today, and it'll probably be continued to be low, then we could see a revival. What we need is the world now has borrowed about $5 to $6 trillion to help the world's economies. And so the big unknown is what's going to be the economic GDP growth in all of these countries over the next 3 to 5 years. And that's going to be a big factor of whether or not we're going to continue to use 1 million barrels a day growth, which is where most people were estimating about 1% per year before the crisis. So it's unknown where it's going, Bruce. In regard to electric vehicles, I've been studying because it does affect our industry significantly. And this week, a couple interesting things happened. Tesla went over $1,000 yesterday. Their market cap is the same as Toyota's. Toyota is the world's largest automotive company in regard to market cap. So you got Tesla now, same as Toyota. You had a company called Nikola that just brought out a EV vehicle for a truck, their first truck. And they haven't even produced one yet. Their market cap exceeded Ford Motor Company this week at $30 billion. Today in the Financial Times, Ford has come out with the F-150, the most popular truck in the U.S. They said they're going to mass produce electric F-150s in 2022. So there's a big movement in that regard, but there are issues with batteries. And the biggest issue with batteries is that a battery pack runs about $15,000 on most cars. We don't have enough cobalt and nickel and manganese to produce over the next 20, 30, 40 years to electrify our entire automotive fleet in the world. And so it's going to take different technologies. Most people are predicting by 2030, we'll probably give up about 2 million barrels a day of the gasoline, which we're using 25 million barrels a day now. We'll give up 2 of that to the electric vehicles, and it could double again. So it's going to take time. Now, the unknown is whether or not countries like in Europe, they're forcing their citizens to move away from fossil fuels, banning the fossil fuel engine. We've seen what's happened in Norway and Sweden, the movement there with electric vehicles. So governments can play a major role in policies and how fast we adopt to electric vehicles. But for the next 10 years, I don't see much change, Bruce.
You know, without a doubt, COVID-19 has disrupted our previous conception of work. You already mentioned how it's touching your workforce at Pioneer Natural Resources. What changes in the way that we work do you think are likely to stay? And how will that in turn affect the workforce of the future?
Yeah, that's a good question. We've been thinking about it. It's like we're evaluating. We moved into a new building. And right now, if we allow a lot of our employees to work from home, we don't need as much space. So we're looking at whether or not should we be subleasing parts of our building if we allow our employees to work from home. And so you can reduce your G&A, your overhead expense. And so you sort of got a question. I've got a lot of friends on Wall Street. Wall Street's probably going to be the last place to open. So people are starting to question the value of real estate long-term, the value of buildings long-term. So that's one of the big changes that's happening. Now the question, whether or not cruise lines come back, whether or not airlines come back, whether or not the countries will open up. I'm confident we're going to get a vaccine and that things will open back up long-term over the next 2 years. I don't see, right now, I don't see any other major changes, John, other than workforce changes, maybe the movement away as the major pandemic. We're in larger cities. And so the people are going to question whether or not they want to live in a large city the rest of their life. So that's going to have some effect. And so there's pluses and minuses that are going to help our industry. It'll have a major effect on our industry. But at this point in time, I can't think of much else that will change.
Scott, let's put on our geopolitical hats now for a minute. I'm always intrigued by this because, as you know, I worked overseas quite a bit and traveled overseas, worked internationally a long time in my career. How do you see the global players in this complex tapestry of the world order in energy, particularly China, Russia, Saudi, the other Middle East? Let's just start with that.
Yeah, those are the most important countries. Obviously, we have issues with China today in regard to the trade war that's been going on now for 12 to 18 months. Some say for the last decade. We have issues whether or not China allowed the pandemic by allowing international people to fly out of the Wuhan province. So we got issues today, and so it's going to affect our energy industry significantly if our relations deteriorate with China, simply because they are a big buyer of our LNG. They're a big buyer of our oil exports. Pioneer has been exporting a lot of oil to China over the last 3 years ourselves. And it'll have a major impact if the situation deteriorates to the energy sector in this country. In regard to Saudi Arabia and Russia, the big question is, Trump is an ally to Saudi Arabia. Most of the Democrats get elected Arabia way. Saudi Arabia may get closer to both China and Russia under a Democratic administration. I see continued push on OPEC by a Democratic administration. There's been a NOPEC bill in regard to banning OPEC, and it's been monopoly over the last several decades, sitting in Congress, and the president has stopped it so far, and several key Republicans in all states. But our relationship with Saudi has to be important long term. A Democratic administration is probably going to redo the Iran deal. And so the Iran deal, if they do it, they'll do it quickly. They'll bring back 2 to 3 million barrels a day on the market at a time. It'll put pressure on OPEC. Saudi and Russia will definitely have to make exporting another 2.5 million barrels a day starting next year. The relationship with Russia is going to be strained. Hopefully at some point in time, it will improve. Sanctions will be lifted, but it's going to take time. But we still have to be a key broker in regard to all of those countries, try to resolve it with any peaceful ambitions in that regard, in regard to all three of those countries, China, Russia, and especially Saudi.
Let me follow up on the China question. They're obviously a big consumer, probably the second biggest consumer, I guess, of energy in the world, maybe next to us. How do you see, we haven't talked a lot about India, but it's been curious to me, India sort of, if you think about LNG, for example, we could send LNG that was bound for China to India just as well as we could send it to China. Is that market open? And it's the second biggest population in the world. It's certainly a developing country, and by all standards. Does India have a place in the strategy of how we realign our geopolitical alliances?
No, I think we have to. In fact, Saudi's already done that. Saudi has realized that the U.S. is no longer their long-term marketplace. They do own the Motiva refinery 100%. They purchase from Shell on the Gulf Coast, and they import historically about 400,000 to 500,000 barrels a day. But what they've done, they've moved all their downstream into China, into India. They've struck deals recently with Reliance, the largest company in India. And so Saudi is already themselves realizing that the growth of the energy industry is primarily in China and India. And so the U.S. needs to keep great relationships with China just for that reason. Also, China is the biggest user of electric vehicles. They're pushing electric vehicles. It wouldn't surprise me at some point in time they will control most of the world's technology in electric vehicles and also battery technology. So they produce most of the batteries in the world now in China. And so the U.S. is gaining relationships and improving with India, but we need to keep India and China on both up front and maintain great relationships with both of them, because our energy products most likely will end up in India or China over the next 20 to 30 years, in my opinion.
Let's follow up on China for a minute. In my view, the one thing they need from us and the rest of the world is energy, resources for their energy. I know they've done a lot to try to clean up their coal, and they're doing a lot of work on nuclear. But in terms of what we can offer in the equation of trade balance and unilateral or multilateral cooperation, this is our one of our biggest trump cards. Not to use the pun there, trump card, but you know what I mean. Does that make sense to you? That we still need to maintain that as our primary, one of our primary influencers in the relationship?
No, I think it's very important. With 1.3 billion people in China, 1.2 billion in India, it's predicted that India will bypass China at some point in time. Long term, a very good relationship with China. If the world blocks China and we all move against China, it's going to hurt the whole world economically. Over the last 20 years, they probably have provided half of the oil growth in the entire world. India's provided about 20% of the oil growth. The rest of it's the other Asian countries, and probably going forward it'll be Africa. We're still going to add 2.5 billion people by 2050. We're going to go from 7.5 billion to 10 billion, and so and most of that is going to be in Asia and also in Africa. So it's very, very important for our administrations going forward to maintain tremendous relationships with both of those countries, both China and India, long term.
Yeah. Thanks for that, Scott. I appreciate it. John, you want to wrap it up here?
Absolutely. Scott, as we wrap up, I'm always interested in what great leaders are learning or thinking about. What have you recently read, listened to, or discussed that has challenged your thinking or perceptions on a topic in the energy industry?
Going through this double black swan environment, I think the question I keep thinking about long term is what changes are going to happen in regard to people's thought patterns in regard to energy use. I'm still trying to decide how fast the electric car revolution is going to occur. I still think my biggest concern is the movement away from fossil fuels. How do we convince our industry historically has done a very poor job in regard to communicating with the rest of the world, especially in the U.S. We have 32 states that produce oil and gas of some kind. So we have 18 states, obviously, that do not. And we've done such a poor job of educating the American public the benefit of the shale revolution. The shale revolution was one of the greatest revolutions we've seen in the past 100 years in this country. It's not as much as the tech boom, but to provide the world with cheap energy and for us to become energy independent. To me, I think we have to figure out a way to stay energy independent long term. We got there. We're probably going to see a drop of a couple million barrels a day in U.S. production, but we still have the prospects. We still have the geology and all these shale plays, whether it's gas or oil. It's going to be here for a long time. So I'm optimistic that we can keep our production around 11.5 million barrels a day for the next 10, 20, 30 years, and we can stay as energy independent. I do not want to get back to where we're importing 60% of our oil sources from the Middle East or from Russia or from countries like Venezuela, because it'll put us back in a situation. And so just continue to educate people is very, very important. Continue to educate it. If we have a change of administrations to do that, we just got to figure out a way to do a better job. So that's what I'm hopeful for over the next 10 years.
Well, we certainly appreciate your leadership and the insight that you shared with us today. Before we go, are there any last thoughts or remarks you would like to share with our audience?
No, I've enjoyed it speaking to you, John, and Bruce. I think most people don't realize that Bruce, the ones that know Bruce, he actually hired me to go to work for Amoco at the University of Texas a long time ago. So we've seen a lot of ups and downs. But I'm sorry the symposium could not meet on time. So I'm looking forward to what y'all do in 2021. So I've enjoyed the discussion. Thank you very much.
Scott, on behalf of the OU Energy Institute, its faculty and students, as well as the broader OU Energy Institute network, I want to thank you for your leadership and the insight you shared during our conversation today. To our webcast audience, thank you for joining the first in a continuing series of conversations the OU Energy Institute will be holding to discuss strategy, leadership, innovation, and the future of the energy industry. We hope you will join us in the coming weeks when we sit down with Michelle Foss of the Baker Institute to discuss the evolving energy transition landscape. Until next time, stay safe and stay healthy.